You know that feeling when you think you've done everything right, bought the insurance, paid for your premiums, secured your family, only to find out later that something was missing. The wrong coverage amount, the wrong tenure, a forgotten disclosure, or worse, a claim rejection. And the worst part, you never saw it coming because no one really told you how this works. Not the banks, not the agents, not the ads, which is exactly why we made this video. The ultimate guide to term insurance in 2025. Folks, this isn't a top 3 plans list. This is your complete, no BS, complete breakdown of term insurance. What it matters, who needs it, how to calculate your ideal cover, how to choose tenure, which riders matter, how the claims process work, and what mistakes people make that can cost their families dearly. And since this video covers a lot, we've made it easy to navigate. You will find clickable chapters in the description, so if you already know the basics and want to skip to say riders or claim processes, go right ahead. And if by the end of the video you still feel overwhelmed, just book a free call with Ditto's advisors. Our guidance is 101, simple, and always spam free. The link is in the description. Now, let's dive in. Term insurance is at its core the cleanest, simplest form of life insurance. So, how does this work? You pay a fixed premium for a fixed number of years, say 30 or 40 years. And in case the person passes away, during that term, their family receives a lump sum payout. That's it. There's no investment, no bonus, no savings maturity. If you survive the term, the insurer keeps the money, and that's precisely what makes it so affordable. It's like renting a protection. You're paying for peace of mind, not returns. And because it covers most causes of death like illness, accidents, or natural causes, it becomes the most effective tool to protect your loved ones financially. But there are some exclusions, and let's now see what's not covered. A couple of standard exclusions that apply to all term insurance plans are: if the insured dies by suicide within the first year, the claim won't be honored. If the nominee is involved in policyholder's death, again, not payable. Deaths caused while participating in criminal acts or under the influence of alcohol or drugs are also excluded. These are fairly standard across the industry and not unique to any one insurer. Now, who should buy term insurance? Well, the short answer is anyone who has people depending on them financially. Spouses, kids, aging parents. If your absence would create a financial vacuum in their lives, you probably need a term plan. Now, let's take an example. Say you're 30 years old earning 10 lakh rupees per year. A 1 crore term cover could cost you around 1,000 rupees or 2,000 rupees per month. That small amount ensures that your family doesn't have to worry about rent, EMIs, education expenses, or day-to-day survival, even if something happens to you unexpectedly. And don't think term insurance is just for salaried employees. Freelancers, business owners, even homemakers can be eligible, especially now with insurers becoming more flexible in underwriting. We cover term insurance for freelancers and term insurance for homemakers separately in 2 different videos. I'll link them below. Now, let's clear one thing up because this is where most people get confused. There are multiple types of life insurance: term plans, endowment plans, whole life policies, ULIPs. Well, they all serve different purposes. But here's how term plans stand out. It offers pure protection. It has no maturity benefit. It's the cheapest among all types of life cover. In contrast, whole life plans offer lifelong cover but are expensive and usually are used for legacy planning. Endowment plans combine insurance with guaranteed savings. It's good for disciplined savings but low on flexibility. And ULIPs blend insurance with marketing investments, high risk, high complexity. So if your goal is to protect your family, term insurance is the cleanest and the most cost-effective route. Now, let's talk about some key features and benefits of term insurance. Now, let's go a little deeper and see what makes a term plan work. You see, as I told you, it's already a pure protection policy. There's no investment component. You get coverage for a fixed term, say 30 or 40 years, and if you survive it, the policy ends. It's affordable, as I mentioned. The premiums are low compared to the cover you get, and there are tax benefits under Section 80C for premiums and Section 10D for death benefits. Now, most importantly, it's customizable. You can add riders like critical illness cover, waiver of premium, or accidental disability to tailor it to your needs. Now, not all term plans are created equal. There are many variants. There is a standard term plan that's called as level term. The most common type, this is fixed sum assured and fixed premium throughout. This is perfect for salaried or self-employed folks with predictable incomes. The next type is something called as return of premium or ROP. Here, if you survive the term, all premiums are refunded. I know, sounds great, but premiums are much higher and the returns aren't as attractive as they seem. Next is called as increasing term plan. This is interesting because sum assured increases every year by 5% or 10% to offset inflation, but premiums are also usually 50 to 60% higher. This might not be for everyone. The next type is decreasing term plan. Coverage reduces over time, assuming your financial responsibilities will reduce too. This works in very specific cases, but not ideal if you think life will throw curveballs later, which it will. Term plans for housewives. This is coverage based on the earning of spouse's profile. The maximum cover is usually capped at 50 lakh rupees to 1 crore. Rider options are often limited, but it's still a powerful tool to secure a non-earning partner. Term plans without traditional income proof. Now, freelancers, gig workers, or informal sector employees can still get covered by showing alternative proofs like bank statements, mutual funds, records, or FDs. There's also something called as corporate term plan. These are employer-provided group covers, usually 3 to 5x your salary. Great as free top-up, but they lapse when you switch jobs, so don't rely on them as your only term insurance. How much cover do you need? There is no fixed number here, but the general rule of thumb is 20 to 30 times your annual income. Why is that? Because the goal of term insurance is to replace your income. Say if you earn 10 lakh rupees a year, you want your family to get the same amount every year for 20 years. So you need a 2 crore cover. Simple. Let's break it down a little further. A 1 crore payout invested at 6% gives your family about 6 lakh rupees a year. 2 crore gives 12 lakh a year, enough to handle EMI, school fees and basic expenses. But folks, don't just look at the income. Also consider your current loans, your children's higher education or wedding expenses, inflation which will eat into fixed payouts, emergency needs that may arise later. Now, if you want calculating this in real terms, just book a free call with Ditto. We'll help you from A to Z and will help you figure out the exact numbers free of cost. The link is in the description. Now, you might have a question, how to choose the right policy duration, because this is also important. Most term plans come with durations ranging from 10 to 40 years, but you can't extend your policy once it's chosen, which means picking the right tenure matters. Ideally, you should be covered till age 60 or 70. But why? Because by then, kids are likely financially independent, loans are repaid, retirement corpus is built. If you still have long-term responsibilities like a special needs dependent or delayed retirement, you can go longer. It's safer to overestimate your needs now than to be unprotected when it's too late to buy. Now, let's talk about some inbuilt features that you should look for in your term plan. You see folks, modern term plans come loaded with some useful features. Let me list them out for you. Terminal illness benefit. If the insured is diagnosed with a terminal condition expected to cause death within 6 months, part or full of the cover is paid in advance. This requires proof from 2 independent doctors. Next is a life stage benefit. This lets you increase your cover after key life events like marriage, childbirth, home loan. The top-up is priced based on your age at that time. There's also something called as auto cover continuance. Let's say you can't pay your premiums for some reason, your cover continues for up to 12 months, giving you breathing space. But yes, you have to pay it back later. Next is the instant claim payout. Some insurers release a portion of the claim immediately on intimation of death, helping with hospital bills, funeral costs, or emergency expenses. Next is the zero cost exit. Now let's say you want to exit at age 60 when you no longer have needs. Some plans let you do that and refund the premiums you paid, excluding taxes and rider costs. This is a neat way to walk away without losing everything. Now, let's talk about the extra toppings that are the riders, which make sense. One is the waiver of premium. If you're disabled or critically ill, your future premiums are waived, but your cover continues. This is one of the most value for money riders you can add. Next is the critical illness rider. If diagnosed with something serious like cancer or stroke, you get a lump sum. Think of it as income replacement during recovery. Next is something called as the permanent disability rider. This is a one-time payout if you lose your ability to earn due to disability. This is crucial if you're in a high-risk job or travel often. Next is the accidental death benefit or ADB. This adds an extra payout if death is caused by an accident. But remember, all term plans already cover accidental death in the base sum, so this rider isn't always worth the extra cost. Now let's see how the application process actually works. It's pretty straightforward, but the key is in the details. Step 1. Documentation and proposal form. You need to submit basic ID proofs like Aadhaar and PAN, along with address proof and income documents. These could be your salary slips, ITRs, or even bank statements if you're self-employed. Once the documents are ready, you will fill out a proposal form. This is where you declare your personal information, nominee details, occupation, lifestyle, and most importantly, your health history and habits. This part can take about 45 minutes to an hour if you're doing it in one go, or it can be spread over a few days if you're doing it online with assistance. Step 2. Medical tests. Based on your age, sum assured, and declared health conditions, the insurer may ask you to undergo medical tests. These usually include basic checks like BMI, blood sugar, and urine analysis. In some cases, ECG, stress test, or even more specialized diagnostics may be requested, especially if you're over 40 or applying for a large cover. These tests can be done either at your home or diagnostic center depending on your location and insurer's bandwidth. You'll get to pick a convenient slot, and most people wrap this up within 1 week. Step 3 is the underwriting and final decision. Once your medicals are done, the insurer's underwriting team steps in. They review your profile holistically, combining your financial disclosures, test results, and based on that, one of the 3 things can happen. 1. Standard acceptance. Your policy is approved as is. Second, counter offer. The insurer might increase your premium, reduce the cover, shorten the term, or drop certain riders. And third is straight up rejection. This usually happens if the insurer feels the risk is too high based on your medicals or disclosures. But folks, there is good news. Even if you get a counter offer or rejection, your premium is fully refunded if you don't accept it. The entire process from submission to approval typically takes 3 to 4 weeks, although many get through faster if there are no complications. Now, if all this sounds very intimidating, don't worry. When you book a call with Ditto, we guide you through every step: paperwork, test booking, follow-ups, all of it, and make sure your proposal is airtight. So, book that free call. The link is in the description. Now, coming to the part where term insurance actually works. What happens if you ever need to file a claim? Now, let's talk about the most important moment in the policy's life. That is the claim. Step 1. Claim intimation. The nominee or the legal heir informs the insurer about the death of the policyholder. This can be done online, over mail, through customer support, or by walking into a branch. There's no strict deadline, but it's always advisable to do it early, within a few weeks. Step 2 is submit documents. For natural deaths, the required documents usually include original policy document, death certificate from municipal authorities, ID and address proof of the nominee, completed claim form, medical records, hospital summary or doctor's note if the death was due to illness, bank details of the nominee for claim transfer. For accidents or unnatural death, add FIR copy, post-mortem report, final police investigation or closure report, Panchnama if available. Some insurers may ask for additional documents depending on the case, but these are the most standard ones. Now, the final step is step 3, that is claim assessment and payout. So, as per the IDI rule, if the documents are in order and no investigation is needed, the claim must be settled within 30 days. If an investigation is needed, say for an early claim filed within 3 years of policy issue, the insurer gets an additional 90 days, bringing the total to 120 days. Digital first insurers often settle claims faster, sometimes within a week, but timelines can vary with different insurers. And remember, there's no difference in service whether you bought your plan online or through an agent. The claim process is regulated, and insurers are obligated to treat all policyholders equally. At Ditto, we help your family through the claim process too, even years after you've bought the plan. That's the part of Ditto's promise. Now, there are some top mistakes that you should avoid when buying term insurance. This part is important because we see these happen all the time. 1. Under-insuring yourself. People often take 50 lakhs or 1 crore thinking it's enough, but don't realize that 10 to 20 years later, that money won't stretch far, especially with inflation and higher family needs. Always calculate your future financial responsibilities and choose a number that offers genuine peace of mind. 2. Choosing too short a tenure. Picking a 20-year policy when your dependents will still need support or for 30 years is a recipe for disaster. Once the term ends, you'll be older, less insurable, and premiums will be unaffordable. So go longer if unsure. Number 3. Hiding facts or making false declarations. Please don't lie about smoking, drinking, or your medical history. The claim rejection will hit your family, not you. Be honest. The insurer will find out anyway during medical underwriting. 4th. Ignoring riders that actually help. Riders like waiver of premium or critical illness may just cost 100 to 200 rupees more per month but offer disproportionate value. Don't skip them without understanding what they do. 5th. Choosing based on price alone. We get it. Cheaper premiums are tempting, but low cost with poor service or claim experience is useless. Look at the insurer's claim settlement ratio, complaint rate, and post-issue support too. 6th. Delaying the purchase. Many people say, I'll do it next year, but here's the truth. Every year you delay, the premiums rise, and worse, a sudden health condition can shut the door entirely. So, the wise thing to do is start when you're healthy. 7th. Never reviewing your policy. Got married, had kids, bought a home, your life has changed, and so should your term plan. Review it every few years and top up if needed. And Ditto can help you with that too. Final thoughts. Term insurance isn't just a financial product, it's an emotional promise to protect the people you love the most, no matter what happens. But it only works if done right. The right cover, the right term, the right features. It's easy to get overwhelmed by options or fall for flashy marketing or just do what a friend did. But your life is different. Your responsibilities, your income, your family, they all need a tailored plan. That's why we exist. At Ditto, we just don't help you pick a policy, we help you understand it. We guide you through documents, explain every rider, suggest what to skip, and even support your family if a claim ever arises. And do you know the best part? Our calls are completely free, so are our services. We don't upsell and we don't spam you. Folks, if this video helped you and you want help choosing the right term plan, click the link in the description, book a free 30-minute call with Ditto. It could be the most important decision you make this year. Thank you so much for watching. Like the video if it helped. Share it with someone who's been thinking about buying insurance. And I will see you in the next one. Until then, happy insurance hunting.